Welcome back to Jimmy Invest. What if I told you that the biggest investing mistake isn't choosing the wrong stock, but investing your money in the wrong order? Every year, millions of people in the United States and Europe work hard, earn decent incomes, and still struggle to build wealth, not because they don't invest, but because they skip the financial foundation. In today's video, we're breaking down the smartest order to invest your money, step by step, so you can build long-term wealth with logic instead of guesswork. Have you ever noticed that whenever people finally have a little extra money, they immediately start asking the wrong question? Instead of asking, "What should this money do for me?" they ask, "Where should I invest it?" At first, those questions sound almost identical, but they lead to completely different financial outcomes. The uncomfortable reality is that many middle-class people in the United States and Europe don't struggle because they never invest. They struggle because they invest in the wrong order. They buy stocks before building stability. They chase returns while paying high-interest debt. They celebrate opening an investment account while one unexpected expense could force them to sell everything a few months later. It's not a lack of intelligence, it's a lack of financial sequence, and sequence matters far more than most people realize. Imagine a 28-year-old office worker living in Chicago, Manchester, or Amsterdam. After taxes, they earn around $4,200 each month. On paper, it sounds like enough to make progress. Friends assume they're doing well because they have a steady job, a decent apartment, and occasionally travel on weekends. But once payday arrives, reality quietly takes over. Rent or mortgage consumes roughly $1,600. Utilities, internet, insurance, and phone bills remove another $400. A car payment or transportation costs another $350. Student loans require $300. Credit card minimum payments quietly absorb another $200. Groceries, fuel, and everyday necessities take another $700 or more. Before they have made a single investing decision, nearly every dollar already has somewhere to go. By the end of the month, perhaps $500 remains. This is the moment where financial advice from the internet begins competing for attention. One video insists that every extra dollar should go into the stock market immediately. Another says real estate is the only path to wealth. Another recommends cryptocurrency because traditional investing is supposedly too slow. Another encourages picking individual technology companies because they have outperformed recently. Surrounded by conflicting opinions, the person begins believing that choosing the right investment is the hardest financial decision they will ever make. Ironically, that is rarely the real problem. The real problem is that almost nobody explains the order in which money should be organized before investing even begins. Think about building a house. Nobody starts by choosing expensive furniture before the foundation exists. Nobody installs a roof before constructing the walls. Yet financially, people often try to decorate a house that hasn't even been built. They buy investments before creating financial stability. It feels productive because investing sounds sophisticated. But sophistication without structure usually creates unnecessary stress. Imagine investing that remaining $500 every month into the stock market while keeping only a few $100s in a checking account. For several months, everything appears successful. The account balance slowly grows. Headlines are optimistic. Markets move higher. It feels like progress. Then, life behaves exactly as life usually does. The car suddenly needs a $1,400 repair. The apartment requires an unexpected deposit after moving. A medical bill arrives that insurance only partially covers. Hours at work are temporarily reduced. None of these situations are extraordinary. They happen to millions of ordinary people every year. But because there was no financial buffer, the investment account suddenly transforms from a long-term wealth-building tool into an emergency savings account. Investments are sold earlier than planned, sometimes during a market decline, locking in losses that had nothing to do with poor investing decisions. The investment itself wasn't the mistake, the sequence was. This hidden pattern explains why many people say investing doesn't work for them. What they actually experienced was instability interrupting consistency. Markets naturally move up and down, but personal financial emergencies usually arrive without warning. When those two events happen simultaneously, people often blame investing instead of recognizing that their financial system was incomplete from the beginning. Psychology makes this even more interesting. Human beings naturally enjoy visible progress. Opening a brokerage account feels exciting because there is immediate action. Buying shares creates the feeling of moving forward. Building an emergency fund, by comparison, feels almost boring. Watching cash sit in a savings account appears unproductive because nothing dramatic seems to happen. Yet the boring decision quietly protects every exciting investment that comes afterward. This is one of the strange contradictions of personal finance. The decisions that feel the least impressive often create the strongest long-term outcomes. Another psychological trap comes from comparison. Social media rarely celebrates someone who quietly saved 6 months of living expenses. Instead, it rewards screenshots of investment gains, stories about buying fast-growing stocks, or people claiming they doubled their money in a short period of time. Viewers naturally compare themselves against these moments without seeing the invisible foundation underneath. What they don't see is whether those investors have stable income, manageable debt, emergency savings, or decades of experience. They only see the exciting result, so they copy the visible action instead of the invisible preparation. Financially intelligent people usually think in the opposite direction. Before asking how much money they can make, they ask how much financial risk they can survive without changing their long-term plan. That single shift changes everything. Instead of viewing every available dollar as investment capital, they recognize that some dollars have completely different jobs. Some dollars exist to pay today's bills. Some exist to protect tomorrow's emergencies. Others exist to eliminate expensive debt. Only after those jobs are assigned does long-term investing begin. This may sound slower, but over 10 or 20 years it often produces more wealth because fewer interruptions force the investor to abandon the plan. Consider two people who each have $10,000 available. The first invests every dollar immediately because they believe time in the market is all that matters. The second pauses, keeps several months of essential expenses safely available, pays off a credit card charging over 20% annual interest, and only then begins investing the remaining money consistently every month. During the first year, the first person may appear more aggressive and confident, but if an emergency occurs or expensive debt continues growing faster than investment returns, that early confidence quietly becomes a financial disadvantage. By contrast, the second person's approach appears slower, but is designed around sustainability rather than excitement. The smartest investors understand that successful investing is rarely about making the perfect decision once. It's about creating a financial system that continues working through ordinary life, unexpected setbacks, market downturns, and changing personal circumstances. And that system always begins with one simple principle. Before asking where your money should grow, first decide what every dollar is responsible for protecting. That single change in thinking is the foundation upon which every smart investment decision is built, and it leads directly to the first step in the smartest order to invest your money. Once you understand that every dollar has a specific job, the next question becomes surprisingly simple. Which job should come first? Most people assume the answer is investing immediately because every headline reminds them that time in the market is important. While that statement is generally true, it is often misunderstood. Time in the market only works when your money is allowed to stay invested. If you are constantly forced to withdraw investments because life becomes expensive, the advantage of starting early begins to disappear. This is why financially intelligent people rarely think of investing as the first step. Instead, they think about creating a system that allows investing to continue uninterrupted for years or even decades. Imagine our previous example again. The office worker earning around $4.200 after taxes has roughly $500 left each month after covering essential expenses. Instead of asking which stock or ETF to buy first, they ask a much quieter question. If something unexpected happens next month, where will the money come from? The answer to that question determines almost every financial decision that follows. If there is no answer, then investing immediately creates unnecessary risk. If there is a clear answer, investing becomes far less stressful because temporary emergencies no longer threaten long-term goals. This is why the smartest order usually begins with building a modest emergency reserve before chasing investment returns. Notice that this does not mean saving years of expenses before investing anything. It simply means creating enough breathing room that ordinary surprises do not become financial disasters. A flat tire, an emergency flight to visit family, a broken washing machine, or a temporary reduction in working hours should not require selling investments or borrowing more money. Even setting aside 1 month of essential expenses dramatically changes how financial decisions feel because uncertainty begins to shrink. Many people underestimate the emotional value of liquidity. They focus entirely on maximizing returns while ignoring the value of sleeping well at night. Yet financial stability is not measured only by the size of an investment portfolio. It is also measured by how calmly someone can handle unexpected expenses without disrupting the rest of their financial life. Once that initial safety buffer exists, the next priority becomes surprisingly mathematical rather than emotional. Consider high-interest credit card debt. Imagine carrying a balance of $5,000 with an annual interest rate of 22%. Every year, that debt quietly costs roughly $1,100 in interest alone if the balance remains unchanged. Now compare that with a long-term stock market investment that might reasonably average around 8 to 10% annually over many years. The numbers reveal something important. Paying off debt charging 22% effectively creates a guaranteed return equal to the interest you no longer have to pay. Very few investments can reliably outperform that kind of guaranteed improvement. Yet many people continue investing while carrying expensive debt because investing feels like building wealth, whereas debt repayment feels like standing still. Psychology once again interferes with mathematics. If there's one idea to take away from today's video, it's this: successful investing isn't about finding the perfect opportunity, it's about following the right sequence with consistency. Small, logical decisions repeated over many years often matter far more than chasing the highest returns. If you found this breakdown helpful and want more simple, reality-based finance content designed to help you make smarter financial decisions, consider subscribing to Jimmy Invest. Thanks for watching, and I'll see you in the next video.